When a bank fails, it should die. That's how markets work. That's how capitalism is supposed to function. A business makes bad decisions, takes reckless risks, loses its money, and it goes bankrupt. The owners lose everything, the creditors take what's left, and the economy moves on. Creative destruction, they call it. The weak die so the strong can thrive. But here's the thing, that rule applies to you. It applies to the restaurant down the street that couldn't pay rent. It applies to the family business that took out a loan and couldn't make the payments. It applies to every single person and company that isn't a bank. Because when banks fail, something different happens. Something that should terrify you. When banks fail, we save them. We rescue them with public money, with freshly printed currency, with debt that gets passed down to people who weren't even born when the crisis happened. And every single time we do this, every single rescue, every single bailout, every single emergency intervention, we don't solve the problem. We make it bigger. We make the next crisis worse. We make the eventual collapse more catastrophic. And this has been happening for over a century now, and almost nobody's talking about it, because the people who benefit from this system are the same people who own the platforms where these conversations are supposed to happen. So let me take you through it. Let me show you how we got here. Let me show you how the modern financial system doesn't prevent banking crises anymore. It just postpones them, growing them larger and larger until one day the bill comes due and there's nothing left to pay it with. Let's go back to a time before central banks ran the world. In the 1800s, banking crises were brutal but honest. When a bank failed, it failed. The doors closed, depositors lost their money. The bankers faced consequences, sometimes literal consequences, angry mobs outside their homes, public disgrace, financial ruin. And yes, these failures caused pain. They caused recessions, they caused unemployment, but they also caused something else. They caused learning. Banks that survived became more cautious. They held more reserves. They made more conservative loans. The system as a whole became stronger because the weak parts were allowed to die. And so in 1913, the Federal Reserve was created. Now, they sold it to the public as a solution to banking panics. No more would the economy be held hostage to the whims of private bankers. No more would ordinary people lose their savings because some Wall Street speculator made a bad bet. The Federal Reserve would be the lender of last resort. It would provide stability. It would smooth out the boom and bust cycle that had plagued American capitalism for generations. But here's the part they don't teach you. The Federal Reserve wasn't designed by reformers trying to protect ordinary people. It was designed by bankers trying to protect themselves. The legislation was drafted in secret at a private resort on Jekyll Island by representatives of the most powerful banking houses in America. The Morgans, the Rockefellers, the Warburgs, they were all there, writing the rules that would govern American money for the next century. And those rules had a very specific purpose. They would ensure that when the next crisis came, and there would always be a next crisis, the banks would have access to unlimited emergency funds. They would never have to face the consequences of their own decisions again. And how did that work out? 16 years later, in 1929, the American stock market crashed, and the banking system imploded. And despite the existence of the Federal Reserve, despite all the supposed safeguards, the Great Depression happened anyway. Thousands of banks failed, millions of people lost everything. The unemployment rate reached 25%. People starved in the richest country on earth. Now, you might think this discredited the central banking idea. You might think people looked at the Federal Reserve and said, well, that didn't work, time to try something else. But no, that's not what happened. Instead, the lesson they took from the Great Depression was that the Federal Reserve hadn't done enough. It hadn't printed enough money. It hadn't rescued enough banks. It hadn't intervened aggressively enough. The solution to the failure of central banking was more central banking. The solution to the failure of bank bailouts was bigger bank bailouts. And this is the pattern. This is the thing you need to understand. Every single crisis since then has followed the same trajectory. A crisis happens. The authorities intervene. They rescue the banks. They print money. They take on debt. The immediate panic subsides. Everyone declares victory. And then, a few years later, a bigger crisis happens. And they do it all again, only more so. More money, more debt, more intervention, and the crises keep getting bigger. Let me walk you through it. In the 1980s, we had the savings and loan crisis. Over 1,000 financial institutions failed. The government stepped in with a bailout that cost taxpayers somewhere around $125 billion. At the time, it was the largest financial rescue in American history. It was unprecedented. It was shocking. And it worked in the short term. The immediate panic was contained. The financial system stabilized. And then we moved on, and everyone forgot about it, because that's what we do. But here's what actually happened. The bailout taught the financial industry a very important lesson. It taught them that they could take risks, pocket the profits when things went well, and pass the losses to the public when things went badly. The technical term for this is moral hazard. It means that when you protect people from the consequences of their actions, they take more risks. And that's exactly what happened. The banks got bigger, the risks got larger, the bets got more reckless. Because everyone knew, at some level, that the government would step in again. Fast forward to 1998, a hedge fund called Long-Term Capital Management nearly collapsed. This was a fund run by some of the smartest people in finance, including 2 Nobel Prize winners. They had developed sophisticated mathematical models that were supposed to eliminate risk. They were making massive leveraged bets on the bond market, borrowing enormous amounts of money to amplify their returns. And for a while, it worked beautifully. They were making their investors rich, and then Russia defaulted on its debt, and suddenly those beautiful mathematical models stopped working, and long-term capital management was staring at losses so large they threatened to destabilize the entire global financial system. So what happened? The Federal Reserve stepped in. They organized a bailout. They got the major Wall Street banks together and essentially forced them to rescue long-term capital management. Sound familiar? It should. It's exactly what Morgan did in 1907. The only difference is that now there was a government institution doing it, with the implicit backing of the American taxpayer. And again, it worked. The crisis was contained. The market stabilized. Everyone moved on. And the lesson was learned once again. Take massive risks. Make huge bets. If you win, you keep the profits. If you lose, someone else will pay. This is where I need to talk about 2008. Because 2008 wasn't just another crisis. It was the crisis that proved the entire system was broken. It was the crisis that should have changed everything. And instead it changed nothing. You know the story, or you think you do. The housing market crashed. Banks had made trillions of dollars in bad loans to people who couldn't afford them. They had packaged those loans into complicated securities and sold them to investors around the world. And when the housing market collapsed, the whole thing came down like a house of cards. Lehman Brothers, one of the oldest and most prestigious investment banks on Wall Street, went bankrupt. It was the largest bankruptcy in American history. And suddenly, the entire global financial system was on the brink of collapse. But here's the part that should keep you up at night. The crisis was caused by the rescues. The crisis was caused by decades of bailouts teaching the financial industry that they would never face consequences. The crisis was caused by banks getting bigger and bigger because they knew the government would save them. The crisis was the entirely predictable result of a system designed to postpone crashes rather than prevent them. And what did we do? We bailed them out. We bailed them out on a scale that made every previous rescue look like pocket change. The Troubled Asset Relief Program, TARP, started at $700 billion. But that was just the beginning. The Federal Reserve opened up emergency lending facilities that ultimately extended trillions of dollars in credit to failing banks. The government took over Fannie Mae and Freddie Mac, the massive mortgage companies that had been at the center of the crisis. AIG, the insurance giant, got $180 billion because it was, say it with me, too big to fail. And it worked. The immediate crisis was contained. The market stabilized. The banks survived. Some of them, anyway. And here's the kicker. Here's the part that should make you furious. Not only did the banks survive, they came out bigger than before. The crisis was used as an excuse to merge failing banks with larger banks, creating institutions that were even more too big to fail than before the crisis started. We didn't solve the problem. We didn't break up the banks. We didn't change the incentives. We just postponed the crisis and made the next one bigger. Let me take a pause here to say something. If you're still watching, if you're following this, you're in a small minority of people who actually care about understanding how the world works. And I appreciate that, genuinely. If this is making sense to you, if you want to see more content like this, take a second to subscribe. Hit the notification bell. It helps the channel more than you might think, and it lets me keep making videos like this one instead of whatever the algorithm thinks people want to watch. Okay, back to the story. Now, you might think that after 2008, after the biggest financial crisis since the Great Depression, we would have learned our lesson. You might think that the governments of the world would have said, enough is enough. We need to fundamentally restructure the financial system to prevent this from happening again. And to be fair, there were some reforms. Regulations were tightened, capital requirements were increased. There was a lot of talk about ending too big to fail. But here's what actually happened. The banks lobbied against the reforms. They watered them down. They found loopholes. And within a decade, they were right back to doing what they had always done, just with slightly different financial instruments. And the central banks, the Federal Reserve and its counterparts around the world, they kept printing money. They kept interest rates at 0 or even below 0 for years. They kept pumping liquidity into the system. And all of that money had to go somewhere. So let me tell you about what happened next. You had a decade of cheap money flooding the global economy. You had investors desperately searching for returns in a world where safe investments paid nothing. You had asset prices inflating across the board, stocks, real estate, cryptocurrencies, everything. And you had a financial system that had learned nothing except that the central banks would always be there to catch them if they fell. And then 2020 happened. And I'm not even going to focus on the health crisis, because that's not what this video is about. What I want you to understand is what happened financially. When the markets crashed in March of 2020, the Federal Reserve responded with the largest monetary intervention in history. They didn't wait. They didn't hesitate. Within weeks, they had pumped trillions of dollars into the system. They bought corporate bonds for the first time ever. They essentially backstopped the entire corporate debt market. They told the world in no uncertain terms that they would do whatever it takes to prevent a financial meltdown. And again, it worked. The markets bounced back. The crisis was averted, and we moved on. But think about what just happened. Think about the scale of what we're talking about here. In 2008, the bailouts were measured in hundreds of billions of dollars, and they were controversial. In 2020, the interventions were measured in trillions, and most people barely noticed. We've become so accustomed to massive financial rescues that they don't even register as abnormal anymore. This is the new normal. This is how the system works now. But here's the thing about printing money. Here's the thing they don't want you to understand. Money isn't wealth. Money is a claim on wealth. When you print more money without creating more actual goods and services, you're not creating wealth, you're diluting it, you're redistributing it. You're taking purchasing power away from the people who hold currency and giving it to the people who receive the new money first, which is, conveniently, the banks and the asset owners. And this is why, despite all the economic growth of the past few decades, ordinary people don't feel richer. This is why wages haven't kept up with the cost of living. This is why housing has become unaffordable in most major cities. This is why young people can't save money no matter how hard they work. The system is designed to protect the banks and the asset owners at the expense of everyone else, but even that's not the really scary part. The really scary part is what happens when this stops working. Because every bailout, every rescue, every intervention requires taking on more debt. The government borrows money to fund the rescues. The central bank creates money out of thin air, and all of that debt has to be serviced. It has to be paid for somehow. Right now, the United States government is paying more in interest on its debt than it spends on national defense. Think about that. The cost of servicing past debt is larger than the entire military budget of the most powerful country on earth. And that's at current interest rates. If rates go up significantly, which they might have to if inflation gets out of control, those interest payments could consume the entire federal budget. And it's not just America. Every major economy in the world has been playing the same game. Europe, Japan, China, they've all been running up massive debts and printing massive amounts of money to postpone the inevitable. They've all been playing the same game of kick the can down the road. But here's what nobody wants to say out loud. The road has an end. There's only so much debt you can take on. There's only so much money you can print. There's only so many times you can rescue the banks before the rescuers themselves need rescuing. And we're getting closer to that point every single day. Now, I want to be clear about something. I'm not predicting that the whole system is going to collapse tomorrow. These things can go on longer than anyone expects. The authorities have become very skilled at managing crises, at kicking the can down the road, at postponing the day of reckoning. They might be able to keep this going for years, even decades. But the fundamental math doesn't change. Every crisis requires a bigger rescue. Every rescue requires more debt. Every debt has to be serviced. And eventually, the numbers stop working. Eventually, the debt becomes unpayable. Eventually, the currency loses its value. Eventually, the music stops. And when it does, when the system finally breaks in a way that can't be papered over with more money and more debt, it won't be the bankers who pay the price. It will be ordinary people. It will be workers whose wages suddenly buy nothing. It will be retirees whose savings evaporate. It will be young people who inherit a world with no opportunities and massive debts. That's who always pays. That's who always pays. So what are you supposed to do with this information? I honestly don't know. I'm not here to give you financial advice. I'm not here to tell you to buy gold or cryptocurrency or canned goods. I'm here to help you understand how the world actually works, because I think understanding is the first step toward being prepared for whatever comes next. Here's what I do know. The system we live in is not designed for stability. It's designed for postponement. It's designed to delay crises until they become unmanageable, and then to manage the fallout in ways that protect the powerful at the expense of everyone else. Every bank rescue makes the banks bigger. Every bailout creates more moral hazard. Every crisis averted today becomes a larger crisis tomorrow. And the people running this system, they know. They know exactly what they're doing. They know that they're building a house of cards. They know that someday it will fall. But it doesn't matter to them, because they won't be around to face the consequences. They'll have retired. They'll have collected their bonuses. They'll have moved to their second homes, and their third homes, and their offshore accounts. They'll be fine. You won't be fine. Your children won't be fine. The ordinary working people who never asked for any of this and never benefited from any of this, they won't be fine. They'll be left holding the bag, trying to build a life in the wreckage of a system that was designed to exploit them from the very beginning. That's the truth they don't want you to know. That's the truth that never makes it into the economics textbooks or the business news or the political debates. The modern financial system doesn't prevent crises. It feeds on them. It grows stronger from them. And it will keep growing until there's nothing left to consume. Every rescue buys time. Every intervention postpones the inevitable. But nothing lasts forever. Not empires, not currencies, and not the belief that printing money can make problems disappear. The bill always comes due. The only question is when. And the longer you put it off, the larger it grows in the dark.